In today's episode, I'm going to do my best to explain what it means when we talk about the secondary market, mortgage servicing right, hedging interest rate locks, the business behind the mortgage origination business. Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC
John Coleman.
Yo, what's poppin'?
Well, today, obviously, the sausage and the frying pan's what's
I know,
poppin'.
I'm actually excited about these episodes. They tend to perform well.
You're excited about these episodes because you can tune the F out
I know,
and
but
just let me ramble.
But I know, like, people appreciate it when you geek out and you explain shit that is not taught in school, Dustin.
Yeah, so people that are geek out, Robbie McCaskill.
Shout out Robbie.
Shout out to Robbie. He's a T-lopper. And Robbie reached out to me via LinkedIn because if you're going to reach out to me, there's two ways. There's really only two ways.
Okay.
LinkedIn.
Okay,
first name Dustin, last name Owen.
Yep.
Instagram at the Loan Officer Podcast.
Yes, sir.
That is the way to get a hold of me. Somebody tried to reach out to me via Facebook.
Stupid.
I'm going to tell you straight up. I wish I could remember who this guy is because
Doesn't
supposedly
matter.
he has a Facebook group with 45,000.
He's not a top producer if he's using Facebook, so that's all I have to say.
Not necessarily.
No.
Not necessarily because we coach people how to expand their network online, John, and I want them using Facebook.
Oh, sorry, my bad. Don't listen to me. That was the wrong answer.
I just hate Facebook Messenger. I think Facebook Messenger is garbage. And because of that, I have the hardest time when people want to communicate with me via Facebook Messenger because LinkedIn is way easier. And Instagram is way easier. Like you can DM me, I can DM you right back. You can hit me up on LinkedIn. Shit, if you want my email address, it's pretty simple.
Uh-oh.
Ready?
Don't do it.
do@tloponline.com.
That was a beautiful.
And I'm not going to tell you John's, but if mine's do@tloponline.com,
mine's fu@tloponline.
I'll let you want to guess.
I wish you would. I wish a motherfucker would try to send me an email. See what happens.
Oh, you know what's so funny? I was out with Scotty, with Redder. Shout out to Scotty Hudspeth, by the way. Loved that connection. Love it. He and I grabbed lunch a couple days ago. And anyhow, you don't even remember this, but the other day when Redder was sponsoring the show, I was rocking their hoodie.
Yes, the one that they just sent to you. Yes, I remember.
Okay, well, Scotty listens to T-Lop.
Okay, and he made it that far into the episode?
And he literally said, "Oh, dude, your co-host, he's funny as shit." I'm like, yeah, he makes the show.
Yeah.
Does he really need a hoodie? I said, you should send him one.
Yeah.
Will he wear it? I said, I can't promise you. I can't promise you.
No.
I said, but you still need to stroke his ego because it's fragile.
Coming from you, that is, oh wow, round of applause.
You're saying those that live in glass houses
porcelain, Dustin. Yeah, go ahead. Yeah.
Yes, yes.
That's awesome.
Yes. So anyhow, but nice. I did want to give Scotty a shout out, just like I want to give Robbie a shout out because Robbie is the muse behind today's episode. We are going to get into mortgage servicing rights. We're going to get into why do companies hedge interest rate locks. We're going to get into the secondary market and what it means to be an investor. And this is how the sausage is made, meaning if we didn't have the ability to hedge interest rate locks, if we didn't have mortgage-backed securities, if there was no such thing as MSRs, the industry as we know it would not exist. It just wouldn't. Like the liquidity, the ability to lock in an interest rate for a certain time period and still deliver. Like the ability for lenders to have a well-rounded economic approach to being able to stay in business. Like these are the things that really matter. And by the way, I'm a sales dude. I'm a marketing and advertising guy. I'm a content creator. I'm a top producer. I have not run capital markets. I have not worked in servicing. Okay. But part of my CMB journey, right? That 2-year expedition that I went on to achieve that designation that is only held by 1,000 other mortgage professionals, that is deemed to be like the masters of mortgage banking. I got to learn this. And I've been very fortunate that I am friends with men and women who run capital markets. And I have attended the MBA secondary conference. And I feel like as a salesperson, oh, I know cap markets, I know servicing, I know MSRs better than most other salespeople. But no, I cannot hold my candle to the men and women who do that for a living. No different than they can't hold a candle to me when it comes to actually being a robust sales professional who generates leads and closes a bunch
I
of
want you to
loans.
start today's episode because you eventually have to think that today's sponsor is just Housing Wire, which is another hoodie that I don't have. But anyway, before we get to that,
this hoodie's legit.
I want you to like quiz me on like, so John, I'm going to ask you like, let's roll reverse.
Okay.
So you talked about MSAs, MSRs. Yeah, that thing. You talked about capital markets.
Yep.
And you talked about like how the sausage is made. So I'm going to do my best to answer those questions. So Dustin, why don't you start off by asking me, how the sausage is made. So like go. Like,
Well, how about before we get started so I can get this off my to-do list?
Go ahead.
Hey, today's episode is sponsored by our friends over at Housing Wire. Look, y'all, Housing Wire is my number one source for industry relevant information. I am a Housing Wire premium member, but if you don't want to be a premium member, straight up, before I became a premium member, I was receiving all of their free articles and their free content. All you have to do is go to housingwire.com, at which point you can sign up and you can be a part of their daily email distribution. Shout out to Clayton Collins, shout out to Diego Sanchez, shout out to Logan Motashami, shout out to Zeb Lowe, to James Kleiman, to the entire Housing Wire family. It is my favorite trade publication. And by the way, their events are starting to become some of my favorite events to attend, especially if you are a regional manager, VP, or above within the mortgage and real estate space. It is a great place to learn, network, and collaborate with other professionals within the space. So thank you to our sponsors, Housing Wire.
There you go.
By the way, this hoodie is legit. It's super comfortable. And John Coleman wears a men's medium.
Thank you.
A
Yes.
men's medium. So
That's
all of
small
his
word.
height is in his legs,
Thank
not
you.
in his torso.
Yes.
All right.
So let's get started. So you started talking about MSAs. Those are marketing service agreements. But let me take a step back.
No, I did not start talking about MSAs, by the way.
Let me take a step back and tell you about mortgages are nothing but widgets. We create widgets and like we put them because mortgages are widgets and like we make widgets for securities and people only buy widgets that we make. That's all mortgages are. Marketing service rights are like basically who you stroke the check to. So you got your mortgage through John's mortgage company, but I'll sell the marketing service rights to like another company. So you actually pay them now, but somehow there's a whole industry behind that where people make money because like on the books, Wall Street, we make widgets that only Wall Street will want to buy. And that's how the sausage is made. When it comes to interest rates, they're very liquid. They're not tied to the Fed funds rate. That's a farce that goes around on the internet. And we make widgets that only, so capital markets.
I love this. Ladies and gentlemen, like prior to 2020, John Coleman couldn't spell mortgage.
I knew how to spell mortgage. I worked at a bank, Pilot Bank. Shout out Pilot Bank. Went under.
Okay. John barely knew how to spell mortgage.
I knew what a loan officer was.
Okay. Nonetheless, he has not been an originator. He has not worked in capital markets. He has not worked in servicing. He has not worked in operations.
I went to college.
He is a content creator who has been working alongside of me as my co-host, producer extraordinaire, and my business partner. And I would give you a solid C minus.
Yes,
a solid C minus,
yes.
which meant you didn't fail.
I didn't study either.
Yes, which that's how you got through 4.5, 5 years at University of Tampa.
It took me 4. I did take summer school 1 year.
Yeah, so 4.5 years at University of Tampa, C minus without studying. That is John Coleman.
Yes.
And so can I go back and
Yes.
maybe correct a little bit of that?
Just probably all of it, Dustin.
Right.
Probably all of it.
So the first thing you do have to know, and you touched on one of my key phrases, which is widgets. Okay, a mortgage is, for all intents and purposes, a widget that we create based on what Wall Street will buy. When I say Wall Street, I'm talking investors. Okay, so that is a mortgage. The only real reason why we have 30-year fixed mortgage instruments, 20-year fixed mortgage instruments, 15-year fixed mortgage instruments at such low interest rates is solely because we can take that loan, that widget, we can package it with a bunch of other widgets. we can turn it into a mortgage-backed security or a bond, and then we can sell that bond to an end investor who is typically like a pension fund. It could be a hedge fund. It could be a life insurance fund. And they love knowing that they just purchased a bunch of debt with a promise to repay. That's the actual note that John Coleman and Dustin Owen and Bob Farragher are all paying their mortgages collectively at an average rate of return of X percent, 4.5%, 3.5%, 7.5%. And they now own that bond, which means they are going to get that interest. Okay. That's why we have the mortgage industry, like the way that we know it. If we didn't have the mortgage industry the way that we know it, we wouldn't have 15, 20, or 30-year fixed instruments, because then the only way that we could go get funding would be truly through a bank, truly through portfolio lending, at which point the terms would be typically locked in for only 3 or 5 years. The rates would be substantially higher because there is no one who is actually purchasing these loans from us, meaning there's no liquidity facility. And there'd be way less lending, which meant we'd have way lower homeownership numbers. So like, it's a good thing in the United States of America that we have the liquidity facility known as Fannie and Freddie. It's a good thing that we package John's loan with Bob's loan with my loan into one mortgage-backed security, and we sell it off to hedge funds, life insurance companies, and pensions. Like, that is all a good thing. Now, how we go about doing so, well, that's what we'll get into. Now, when I talk about the widgets, the way that I love to explain a widget is we, as the originator, which most of us in this industry, most of our listeners and our viewers on YouTube, right? We are the widget makers. We only make the widgets that Wall Street will buy. So if Wall Street's willing to buy a loan for somebody that doesn't qualify using traditional income, and we're using a debt service coverage ratio, DSCR, as a qualification, we will do that loan all day as long as there's someone willing to purchase it. We will make those widgets as long as we have a buyer for the widget. That's why I call loans nothing more than widgets. So good job on that. But MSR is a mortgage servicing right. Yeah, mortgage, not marketing. Damn. This is not like MSAs are a thing, John. MSAs can be one of two things. It can be a marketing service agreement. That's where I'm paying Keller Williams $10,000 a month. In return, Keller Williams is going to give me an office within their brokerage. They're going to let me speak at their company meetings. They're going to give me X exposure on every listing, Y exposure on their website. And there's an actual benefit me as a lender is getting in return for that marketing service agreement. And MSA is also a way to talk about like a geographic area. Right? Like Orlando, there's an MSA called the Orlando MSA. And that MSA stands for something totally different. But when we're talking about MSRs, MSR stands for mortgage servicing right. So let's get into MSRs, because what I explained just a minute ago didn't really get into MSRs. It just talked about more or less how the sausage is made, right? It talked about a mortgage-backed security. That's an MBS, which is different than a MSR. So an MBS, just for clarification purposes, an MBS is essentially when we take John's loan, my loan, Bob's loan, and 97 other people's loans, and then we package them and we securitize them. That's turning them into a bond. And then we sell them to an end investor. What that end investor is buying is a mortgage-backed security or a mortgage bond. And what they want a guaranteed rate of return. So they're going to buy those 100 loans that are worth $35 million that are spitting off an average rate of return of 5.5%. That's what they want. They could have bought a 10-year treasury. They could have bought a municipal bond, but they chose to purchase a mortgage-backed security. It has a certain risk component that they like, as a certain rate of return. Because anyone who's in investments, whether you're buying stock, whether you're investing in mutual funds, or you're balancing your 401k, it's all about being risk mitigated, right? Risk reward. More risk you take, the more reward you should expect. The lower risk you take, the lower reward you take. And you always want to be diversified in your investment. So those three types of entities will want to purchase X percent of mortgage-backed securities, which are mortgage bonds. It is those bonds that allow us to have 15, 20, and 30-year fixed instruments. If we didn't have those bonds, we wouldn't have 15, 20, 30-year fixed loans. And it's Fannie Mae and Freddie Mac primarily, along with Ginnie Mae, right? So Ginnie Mae would be FHA, VA, USDA loans. Those are the government or quasi-government entities that will actually allow me as a lender to deliver loans to them. They actually package them and sell them.
What came first, like the chicken or the egg? Like, was all this back end stuff created first and then mortgages started? Or like if I went back to like the 1800s and I had a deed to a land,
Yeah, mortgages have been around for ages, right? I mean, mortgage is actually like two Latin words put together.
For death.
Yes, correct. Yeah, something like mort is death and
paid until you die.
Yes. So lending has been around, just like insurance has been around for centuries, if not millenniums. Yeah. But the mortgage world as we know it started with HUD and FHA financing back in the 30s. Okay. It took off post World War II with the Department of Veterans Affairs and the VA home loan. And then we had Fannie Mae brought into the fold, and eventually Freddie Mac was brought into the fold. Fannie and Freddie were always quasi-government agencies. Now, since the financial collapse of 2008, they've been under conservatorship, which has basically deemed them to be government entities, but they were at one point quasi-government, meaning they were supported by the government like a utility, but they weren't truly owned by the government. They actually had shareholders. In fact, I own Fannie Mae stock. It's not worth a whole lot. It's worth way more today with the Trump administration in than it was in the previous administration, but it's still not worth a whole lot of money because of the conservatorship nature. But Fannie and Freddie, along with HUD, and then Department of Veterans Affairs, which collectively kind of make up Ginnie Mae Securities, they allow us to have this liquidity facility. So banks always know that they can lend money, and as long as they follow Fannie's rules, Freddie rules, or FHA's rules, or VA rules, somebody will purchase that paper from them, which means the bank now has freed up their capital to go lend on auto loans or commercial loans or credit cards. Because as a bank, how do banks work? Well, banks work pretty simple. John and Rob and Dustin all go to the bank and we deposit money. And they'll say, hey, we'll watch over your money for you. So it's in a safe place and we'll pay you 1 or 2% interest on your money. Then when your friend or your neighbor needs an auto loan, they basically lend your money, my money, and Bob's money, but they lend it at a 7%, and they use the automobile as collateral, right? That is how banks operate. And then I think it's the movie A Wonderful Life. If you go back and watch that movie, black and white, almost 60, 70 years old now, there's a place where a gentleman owns a bank, and there's a run on the bank because everybody came and wanted their money. And the guy's like, dude, I can't give you your money. Well, why can't I give you your money? Well, your money is actually in John's house. Your money is in Bob's business. And that's kind of how banking works in general. So if we relied solely on banks to do portfolio loans, eventually there would be a captive amount of lending that could have been facilitated. After that, sorry about your luck, there's no availability. Also, when you do that, you'd have higher interest rates, you'd have shorter terms, and higher qualifications. Like, what if banks are like, yeah, you got to put 25% down? Well, VA is no money down, and FHA is 3.5% down, and Fannie and Freddie both have 3% down options. You can see where these liquidity facilities, these government entities, have played a vital role in promoting homeownership throughout America for going on a decade now. Okay. So mortgage-backed securities, that's what that is, MBS. Now, and there's, by the way, two different types of MBSs. There's a UMBS. U stands for unified, because there used to be a Fannie MBS and a Freddie. Then they just started commingling them. Now it's the UMBS. So there's basically the Fannie Freddie pools, and there's Ginnie pools. And there are some private labels out there. Like any non-QM loan is going into a non-QM private label. We don't have enough time for me to really disseminate and dissect and then teach that. Just know from a high level, mortgage-backed securities are how we are able to make our widgets, package our widgets, and then sell them to somebody who wants to own hundreds, if not millions of widgets, as long as those widgets are spinning off some kind of a dividend or an ROI. Right. Okay, so that's MBSs. You are wanting to know more about MSRs. Now, what does MSR stand for, John? And can you explain to the audience in your best understanding, what is an MSR?
Marketing.
Nope. Not marketing.
Mortgage servicing rights.
Okay. So think about those words: mortgage, servicing right.
Yeah.
Okay, what is a mortgage servicing right?
Mortgage servicing right is you get your loan through lower, and you stroke your mortgage to lower, but eventually I'm gonna sell the right to service your mortgage to some third-party entity. So while I originated your loan, you no longer stroke a check to me. Now you stroke it to David's Car and Mortgage Servicing Shop, LLC. So you did your loan with me, and I love you for it. You're like my customer for life or some shit. But when you pay in the mail, you'll be like paying somebody else. Don't worry about it. It's just a whole nother third-party business. You're good. Don't worry about it. You still own the home. That's what it is. And like, I'll sell the servicing rights to your mortgage to some third party, and then like I'll charge interest on that. And then there's a whole nother widget factory that loves buying them MSR widgets. And then there's a whole nother. You know what? There's some companies that just service mortgages. They do nothing else. Did you know that, Dustin?
I did know that, John. I'm going to give you a B+.
Wow. On a bell curve.
A B+, especially for the first 70%.
Okay.
Then I loved listening to you ramble, because all the rambling that I do, right, all the rabbit holes that I get lost in,
right,
I was like, yeah, there he goes. He's rambling.
Yeah.
Because you couldn't find a way to circle back and put a bow on it.
I didn't. So then I just stumbled my way through, and then I'm like, wait a minute, what was I talking about? It's your fault. Bah humbug. What, you got me on this tangent. Quiet, you. Yeah, it's your fault. That's exactly right.
Yeah, you like how I do that. That's why you and I play off each other so well. Right. So no, you crushed it. So a mortgage servicing right, an MSR, is truly the right to service a mortgage. Like, let's work it backwards, but let's discuss what that really means. Because Fannie Mae and Freddie Mac may have been where that lender or that bank delivered the loan to. And Fannie and Freddie very well may have packaged that security and sold it to the hedge fund, to the life insurance fund, or the pension fund. But here's the deal. That life insurance company, that hedge fund, they don't service loans. They don't have a way of collecting payments. They don't have a way of paying insurance. They don't have a way of sending out late notices. They don't have a way of answering questions when someone has a question. No, they literally just want their money. And the money that they want is every single month, they want the interest and the principal. Because think about it. When I pay my mortgage, I'm paying principal and I'm paying interest. Well, the person who owns my actual loan, who owns that widget, they're expecting to get paid. They're like, hey, pay daddy. Every month, pay daddy. Where's daddy's paycheck? And it needs to be the principal that was remitted as well as the interest that was paid. Which remind me to circle back, because there's a reason why mortgage servicing rights become less valuable throughout the duration of a loan, because as loans stay on the books for longer, there is a smaller unpaid principal balance, and there's a higher likelihood that that loan will eventually get paid off. So people that are purchasing the mortgage-backed securities, they have things in their formula such as duration, such as rapid prepay, such as risk that they have to solve for, because they understand that although they bought that security for a certain dollar amount, and securities do have a dollar amount, $100, $1,000, whatever the case may be, that they're purchasing, they understand that, well, the longer they own the security, the less interest they're collecting because people are paying down their loan. The longer they own the security, the more likely someone's going to pay it off, which means they have less total dollars that's collecting interest. And the longer they own the security, they expose themselves to unfortunate economic events that could lead to people not paying their mortgage. If they don't pay the mortgage, will they ever be able to collect the principal that's owed to them? So that's on the mortgage-backed securities. Now on the MSRs, yes, you can't make your payment to Fannie Mae. Yes, you can't make your payment to Freddie Mac. You can't even make your payment to Ginnie Mae. So you did a VA loan or an FHA loan or a USDA loan. You're not making your payment to them. But by the way, your bank or your lender, you know what they did to your loan? They definitely sold it to Ginnie, which you can't sell to Ginnie. You actually securitize the pool and then it becomes a Ginnie pool, but just follow along at home. So you can't make your payment to FHA or VA, and your bank didn't keep that loan on their books because they wanted to recoup their collateral. They're in the lending game. So somebody gets the opportunity to service your loan. Sometimes, let's use Chase as an example, one of the largest banks. I do my banking with Chase. My financial advisor is at JP Morgan. Like, I'm a Chase dude. I'm also a credit union dude. We got a lot of money at a credit union too because we've been with them for like 40 years. But when I did my loan with Chase, then Chase sold my loan to Fannie Mae. But guess who I make my payments to?
Not neither one of them.
Actually, I make my payments to Chase.
Okay.
Okay, I legitimately make my payments to Chase. But Chase doesn't own my loan. Nope, some hedge fund owns it. Chase just retained the servicing right. And Fannie Mae makes sure that I get I get a fee every single month, every single year based on the work I perform servicing that loan. So that's me and Chase. Now, John, you work for Lower, and Lower has great interest rates and great service. So you're like, I'm going to keep my business within the family. So you call up Chelsea Wagner. Chelsea Wagner takes great care of you, and you get your home loan. Now, Lower decided, you know what? I'm going to sell this loan to AmeriFirst. So AmeriFirst purchases the loan from Lower. Now, AmeriFirst, they deliver your loan package to Fannie Mae. And then from there, Fannie Mae goes to AmeriFirst. Well, do you guys want to service it, or do you want to sell the servicing somewhere else? AmeriFirst says, look, we bought this from Lower. We're now going to deliver the security to you, but we want to retain the servicing right because AmeriFirst is like one of the biggest servicers in the country. I get them confused. I say AmeriFirst. Unfortunately, AmeriFirst is a company that recently was consolidated into Union Home Loan. Shout out to Mark Jones, though, because Mark Jones was the owner of AmeriFirst. I'm actually talking about AmeriHome. AmeriHome's a massive aggregator and servicer, just like Lakeview, just like Planet, just like New Res, just like Mr. Cooper. Like, these are major servicers. United Wholesale Rocket, major servicers. So Lower could do that. So please know that when we're talking about making the sausage, there's multiple ways you can make it, right? I was in New Orleans. I legit had crawfish sausage. That may gross some people out, right? They want pork sausage. Someone else wants chicken sausage, but it's all sausage. So please know the sausage can be made different ways. I can go to Chase, do my loan with Chase. Chase still delivers my loan to Fannie and Freddie for the liquidity piece of it so they can get their money back, but they retain the servicing. I could do my loan with Lower. Lower could deliver it to AmeriHome, which still delivers it to Fannie and Freddie, Fannie or Freddie, but they retain the servicing right. Or Lower themselves can choose to be like, you know what? This loan, I want to keep the servicing rights, but I still need to deliver the actual security to Fannie and Freddie. So there's a big component that goes on with this. Well, when you have a servicing right, here's what you're earning. You are earning 25 basis points a year to service that loan if it's a Fannie Freddie loan. So 25 basis points. So to put that in perspective, a $300,000 loan, you are making $750 a year to service that loan. $750 a year to collect 12 payments, to send notices, to answer questions, to make sure taxes and insurance get paid on time. And then if someone isn't making payments, you now have to go into loss mitigation and you have to work out modifications. $750. That's for a Fannie Freddie. That's for a UMBS. That's the right, what you're paying for, or what you're getting if you're a servicer. On a Ginnie security, again, FHA, VA, USDA, that's Ginnie Mae, it's 50 basis points. So on a $300,000 loan, you're getting a fee back from Ginnie of $1,500. So those hedge funds, life insurance companies, pension companies that purchase the security, it may have been at an average coupon of 5.5, but they may only be seeing 5 because that 0.5, that 50 basis points is actually going to the servicer, which the hedge fund and the pension fund's totally fine. Be like, yeah, y'all service it. We don't want to deal with that. And servicing is a game that I have learned. It's a game of volume. You're either all in or you're all out, because you're only collecting a few $100 or $1,000 for every loan. You got to have a massive scale and a streamlined assembly line process in order to do that. Now, when you're servicing, those MSRs have value. So I could have a bunch of servicing rights on my books. And if interest rates go from 5 to 7%, what's the likelihood that all of those mortgages that I'm servicing are going to be paying off soon? Rates went up. So they went from 5 to 7. Do you think it's more likely or less likely people are going to refinance?
Less likely.
Less likely. Do you think it's more likely or less likely they're going to sell their house to buy another one?
Probably less.
Less likely. So when I have a bunch of interest rates at 5% and rates go to 7, those servicing rights become more valuable. So just like with a stock, the value of the right to service a loan is something that I can trade, I can sell, I can even leverage it as collateral. Like let's say I had $10 billion of servicing rights. Those $10 billion times 25 basis points has a value. I could go and actually take a loan out from a bank and use my servicing rights as collateral. No different than you take a loan out of the bank and use your car as a collateral. Take a loan out of the bank, use your house as collateral. I can use my servicing rights as a collateral. Now, what happens if I have a bunch of servicing rights at 7% and rates drop to 5? Oh, shit. Yes. Oh, shit. Because now all of a sudden, I have this book value, quote unquote. If you're not watching this on YouTube, I just use air quotes. If you're not watching this on YouTube, do me a favor. Go to the TLOP YouTube channel, The Loan Officer Podcast on YouTube, and subscribe. I love watching our numbers tick up. We're pretty close to 30,000 subscribers. So if you go today and you get a couple thousand of your friends to do the same thing,
couple thousand friends.
That's all it takes. Yeah. But back on my mortgage-backed securities, my MSRs, please know that they have a value. So like in real world, 22, 23, 24, you had these lenders that were booking servicing at 2.5%, 3% interest rates for all these refis they were doing in 2020 and 2021. Then all of a sudden, when the world went cold and there were no transactions, those same companies saw the value of their servicing double. Because all of a sudden, when rates jumped from 3% to 6%, the likelihood of somebody actually refinancing dropped. The likelihood of them selling their house and buying another house dropped. Now all of a sudden, the duration, the length of time that somebody's going to be able to keep that asset on the books, the length of time they're going to be able to continue to service that loan has just increased. Now, if they ever got into a pinch and they couldn't afford to pay their bills, well, they do what any one of us does when we can't pay our bills. What do? You sell some stock. You cash in your 401k and pay the penalty. Many mortgage companies did that and are still doing that in 23, 24, 25. As Seth Sprague taught it to me in School of Mortgage Banking too. Shout out to Seth Sprague. If you can ever listen or learn from Seth, I would highly advise you do it. But, Seth taught me that mortgage servicing is the natural hedge to mortgage originating. When you are crushing it with originating new loans, you're probably losing your butt in servicing. Because the reason why you're crushing it is because rates have dropped. That means that you're taking a hit in your servicing portfolio. When you're getting your rear end handed to you with originations, you're probably crushing it in servicing. So an MSR is a asset. An MSR is the actual right to service a loan. And there are companies that's all they do, because Fannie and Freddie don't service loans. Fannie and Freddie securitize and then sell those securities to investors. Those investors, all they care about is getting their money. That's all they care about, right? Give me my interest, give me my principal, make sure I get paid and paid on time. So someone has to step in and service. So then you stop and think, well, why would someone want to service for just 25 basis points, for just 50 basis points? Because guess what, by the way? Servicing is risky. Servicing is risky for two reasons. One, it is highly regulated. If you think loan origination is regulated and the CFPB is like breathing down the neck of originators, I promise you they breathe down the neck of the servicers just as harshly. And you can also lose your rear end in servicing, because when you're a servicer and you sign that contract to service a loan, I'm also getting into a legal agreement with the end investor, again, the hedge fund, the pension fund, or the life insurance fund. I'm getting into a contract with them that regardless if John Coleman pays me on time, I will make sure that either the principal, the interest, or sometimes both the principal and interest still get remitted. That means I have to front all that money until eventually we can foreclose on the property, sell it, recoup what is owed, and give that money to the end investor because they ultimately own that mortgage. Well, in some states, that could be 16, 18, 24 months.
Damn.
So that's 16, 18, 24 months that as the servicer, I'm legally obligated based on when I sign this contract to service the loan, that I'm going to remit based on a schedule. It could be actual, it could be scheduled actual, it could be scheduled. There's various ways that you can remit it. Again, not for this podcast for sure. That you have to do that. Well, what happens when it's one loan? No big deal. 5 loans, no big deal. We have an economic crisis like we saw in 2007, 8, or 9. It's a big freaking deal. And if you're a servicer not tied to a depository, i.e. a bank, you may very easy run out of money and not be able to not be able to service the loans that are in default. That's how it's risky. You also have the risk of, I have all the servicing, it's on my books. And then we have this catastrophic event, economy goes in the tank, interest rates all of a sudden go from 7 to 3.5. You're now taking a bath on all of those loans because their value just got cut in half. Nobody wants to be servicing a loan at 7% because you know it's going to pay off. People are going to refinance to 3.5. So all of a sudden that's not worth any money. But on your books, according to your accounting, those MSRs had a value. So when you study earnings reports, like earnings are getting ready to come out because, it's second week of February, we're going to have Q4 and end of the year earnings. And you'll see some mortgage companies may have made $100,000 in originating, but lost $150,000 in MSRs. Now they'll claim that's not a tangible loss, that's a paper loss. So they'll claim that we didn't really lose money, just the value of our servicing went down. Just like there were years, 23, 24, where mortgage companies like, oh, we made money. No, you only made money because you were selling your mortgage servicing rights, because you booked a bunch at 3.5% coupons, and now rates are at 7. You're losing your rear end and originating, but thank God you have all this stock, let's call it, all these assets, and you're selling your assets. So it's your way of showing that your company is solvent, your company is profitable. It is why Seth Sprague teaches the natural hedge is servicing against originating. And when you're losing money in one, you should be making money in the other.
This is fascinating stuff, Dustin.
All right, so my last thing I want to talk about is hedging, because you can hedge your servicing portfolio with originating. You can hedge originating with servicing, but you also hedge interest rate locks. And that's what I don't think even the consumer understands, is that when John Coleman comes to Dustin Owen to get a loan, okay, John Coleman does not yet have a security that Dustin can deliver to the secondary market. Like, you don't. You may come to me, you're like, hey, here's my loan application, here's my sales contract, and I'm closing in 30 days. But what's the one thing you want me to do immediately with your interest rate? You want me to...
I want you to lock my rate now, damn it.
Yeah, you want me to lock you in.
Yeah.
Okay, and I want to commit to you that I'm going to lock you in.
But I can't.
No, I do.
Oh, I know, but I can't commit to you.
Well, you need to commit to me.
I know, I'm sorry.
You have commitment issues, don't you?
I do.
Okay, well, you're going to commit to me. I'm going to lock you in. But here's the deal. I won't have a loan to deliver for 30 to 45 days. I have to process, underwrite, fund, and close your loan. I then have to go through probably a post-closing audit. Then I have to deliver your loan in the secondary market, which could take 3 days. It could take 13 days.
Whoa.
Okay, depending on the back and forth of due diligence between both parties, the seller and the purchaser, right? Because I'm selling your loan to an end investor at the end of the day. Whether the end investor is Fannie and Freddie and I'm going to retain the servicing, or whether the end investor is a Planet Home Lending or a New Res and I'm selling the whole loan. Either way, I have to sell it, and there's a back and forth before that end investor purchases it, okay? So when I commit to your interest rate, do you know what Apple stock's going to do in 2 weeks, Sean?
No.
Do you know what the S&P is going to do 10 days from now?
Probably go down and go back up.
Okay, none of us know, right? And if we did,
Yacht in Fiji.
We have our yacht in Fiji. Yep. So in order for me to commit to John Coleman that I'm going to lock in this interest rate, I actually go into the market and I place a bet against John's interest rate. That's called a hedge. Okay, if we were gambling, and I picked the Buffalo Bills to win the Super Bowl and I picked them back in August, and I was getting 10-1 odds. Okay, and the Bills win the AFC, and the Bills are taking on the Commanders. I know that as long as the Bills win, my $100 bet is going to pay out $1,000. But if I wanted to hedge my bet, why don't I just put $500 on the Commanders to win? And here's the deal. Either way, I'm a winner. I'm locking in my winnings. The difference is I'll never win $1,000. The most I can win is $500, right? If the Bills end up winning, I win my $1,000 because I placed that bet back in August. I placed the bet on the Commanders in February, but the Commanders won. I won $500, but I lost my $100 bet on the Bills, so I'm plus $400. If the Bills win, I lost my $500 on the Commanders losing, but I still picked up my $1,000, so I'm plus $500. Either way, I'm a winner. That's called hedging your bets. We can hedge our bets with John's interest rate, and the only way that lenders are able to lock in John today for 30, 45, 60 days, knowing they're not going to deliver that loan into the actual market for 45, 60, or even 90 days, is by placing a trade against it. So I bet with John that rates will, if I locked you in at 7, I'm betting rates are going to stay at 7 or go down. And as long as rates stay at 7 or go down, then I'm good. But I have to protect against, what if rates go to 8 by the time that John closes and I can deliver that loan? Well, now I'm taking a bath, and that bath could be 9 or 12 grand swing, which would crush my business. So I need to go out and place a bet that I think rates will be 7.5% in 45 days. So now if rates go down, I lose my ass on that bet. If rates go up, I lose my ass on John's loan, but I made it up on that bet. And that bet is called a TBA. It's a to be announced. It's my way of purchasing future trades. That is called hedging. So when mortgage originators are like, well, the market got better, I just don't know why we can't just give the client the new rate. I'm like, because you have to understand, in order for me to give John the commitment that his rate is going to be solid for the next 30 or 45 days, I had to go place a trade against John's bet. So when rates go to 6.5, I can't just willy-nilly give John 6.5 because I'm going to be losing my rear end on the trade that I made to hedge John's interest rate lock. So it's just not that easy that, oh, well, rates are better, let me give the consumer a better rate. The same exact that allowed me to protect John against rates going to 8 is the same thing that prevents me from being able to drop my pants and just give John 6.5 when the rates go to 6.5. So mortgage originators need to know that just like MSRs are a natural hedge against originations, that when I'm locking in someone's interest rate, there is a hedging strategy that is taking place where I'm protecting my company against losing my rear end. Now, there are some strategies out there, maybe this would be my funny way of putting a bow on today's episode, where you can run naked. And running naked is when you have no hedge in place. Running naked is I'm just so confident that rates are going to be going down. I'm not going to place any hedge, or I'm going to place a very minimum hedge against rates going up. And look, I will tell you this about running naked. It is super fun.
Booty cheeks in the wind.
Until somebody has to go on the registered sex offender list. At which point, it probably wasn't worth going streaking in the quad. It is super fun until somebody
gets hurt,
gets hit by a car, and they're butt ass naked in the middle of the street waiting for the ambulance to come.
That is not
so like running naked is not the most advisable strategy, yet there are mortgage companies that do it, just like there are certain investors that push the envelope more than others. Life is all about risk-based decisions. Some people have a much bigger appetite for risk. Maybe it's out of ignorance or stupidity or just being pure crazy.
Both.
Some people don't have enough appetite for risk, at which point maybe someone should encourage them to be able to maybe loosen up the reins a little bit and take on more risk. But for Robbie, I hope this episode hit the nail on the head for what you are looking for.
Yeah.
Look, originators, if you truly want to learn this, I promise you, it won't help you generate more leads. It won't help you fund more loans. It will, in a sense that when you start having conversations, people will be like, damn, that dude's smart. Damn, that dude knows what he's talking about. At which point you might get people to trust you a lot deeper and more emphatically, at which point you'll be their guy. But surface level, it's not. But if you truly wanted to learn it, because like for me, I wanted to learn it because I'm trying to be a mortgage ambassador. I want to be a change agent. I want to be the future of mortgage lending. And at one point I was asked to run a mortgage company, at which point at that time, I wasn't ready for many reasons. And one of those reasons is I felt like, well, could I legitimately help manage a servicing department, help manage investor relations, help manage capital markets? No. At least now, yes. I know who to hire, why to hire them, and I can have an intellectual conversation with them where I can participate in the decisions that they're making, but they would still be the subject matter expert. So if you ever want to own your own mortgage company, run your own mortgage company, by all means, School of Mortgage Banking 2 through the MBA, legit. School of Mortgage Banking 2, do it in person. Now, I did School of Mortgage Banking 1, 2, and 3, which gives you this AMP designation. AMP is nice. It's nothing like the CMB journey. But I did mine because I knew my career was one in which I wanted to be the most well-rounded in the room. I wanted to one day put myself in a situation where I would be able to run a national top 10 lender. And that was some of the deficiency. If you're just trying to dominate, make a couple $1,000,000 a year being a loan originator, it's a good to have. It's not a need to have. But I would highly suggest School of Mortgage Banking 2 and learning from guys like Seth Sprague. Robbie, John.
Thank you, Robbie, for that extra long episode I had to sit through. So send me a check or just a Louis Vuitton clutch, please.
Beautiful. And then if you are looking for more, if you want more, if you like content like this, I'm just going to walk you through the good, the better, and the best. Okay, the good is if it's free, it's for me. Go to our YouTube channel, subscribe. That's free. Keep on tuning into this podcast, whether it's on Spotify or Apple. That's free. Go to our website, tloponline.com, and sign up for our newsletter. That is free, and it's written by me. It comes out every single Tuesday and Thursday. If you sign up for the newsletter, you will get invited to one free coaching call that I teach every single month. Again, that's free. So that's all good and it's all free. If you want better and you are in origination, check out everything we're doing at the Originator Coaching Community. It's called TLOPS Originator Coaching Community. Whether you're newly licensed, you're a $100 million producer, we are creating sales training, we are scripts, marketing ideas, 8 live coaching calls done by me and my coaches. My coaches are all top producers in the industry. Join that community. It's the best value in the industry. You are the product. Invest in you. And if you want best, we are now offering in 2025 signature courses as well as one-on-one coaching and consultation with me. And then finally, if you're curious about getting me out to your event, whether it's a private event or whether it's a conference or a trade organization, go to our website. You can find out how to find us and create a media inquiry. That website, tloponline.com. All of the signature courses, tloponline.com. The newsletter, tloponline.com. He is John Coleman. I'm Dustin Owen. If you want to connect with me, the best spots, LinkedIn, first name Dustin, last name Owen, or Instagram at the Loan Officer Podcast. That is all the time we have for you today. We do look forward to catching you on the next episode. Peace.